Good morning, everyone. All right, so today we're going to be talking about risk management because I'm sure on this drawdown a few of you got dinged up pretty bad, and I've heard that some of you have only been trading for a few months. So we've been in a massive bull run. This is going to be some examples I share since July. So you've probably gotten away with some questionable leverage positions with very poor risk management. You trade down here. It's like, well, we haven't really had any retracements. Um, so what I want to do is talk about how you protect yourself when the market goes against you, but also how statistically you're not really going to make money unless you use these ideas. And every professional trader uses them. There's no way around it really. And I'm going to give an example of a professional trader who uses tight risk management with only 1% risk in the stock market, and he was able to grow his account from $9,000 to $81 million over the course of 7 years. His name's Christian Kilamagi, and he's a Swedish trader, and he just recently revealed and talked a lot about his system. And so he's a breakout trader, but we aren't going to go so much into his system. I'll move this over for now, as we are going to go into his risk management. So the way he would trade is he would look for bullish signals in an asset. I'll just use the Bitcoin chart here. And then he noticed that there's a pattern where you have these areas of consolidation and then another run up. So he likes to trade the breakout. And so what his system is he puts a order in at the top of this breakout with it's at the start of the daily candles where his stop loss is, but I'll just say the bottom of this consolidation area. And then he has his targets to the upside, right? And take profits along the way. So let's just say this is a 3.5% risk. He only allows 1% risk if he gets stopped out here. And so the way it works is this order would have come up, the breakout would have failed, stopped him out, and then he would have waited for another breakout to the upside to trade again. And he would have just taken the hit. So he was able to turn $9,000 into $82 million with a 70% loss rate. And this is why it's so important to understand risk management is losing in trading isn't a bad thing, right? It should be built into your system because you whether you know it or not, your system has a certain over a large number, a certain statistical probability of losing and winning. Okay, you probably don't know the statistics on your system. In fact, you're probably not even using a system. You're probably using a lot of different ideas, but a proper system knows on average how many losses it's going to take, how many wins it's going to have, and what its kind of maximum statistical loss streak is going to be. So, for example, if you have a 70% loss rate, there will be times where it'll be very likely that you'll run into a 5 to 6 trade loss streak. And so your system needs to be able to handle that. And that's of no fault of your own, it's just the way the market works. In fact, breakout trading has a high loss rate. So the idea is your winners can be big, but you're going to lose a lot. So you want to keep your losses small and your winners big. So in this case, because his stop loss is, let's just call it 2.5, let's call it 3% away to make it easy. If he had a $1,000 account, he can put $300 of his account into this position. So if he gets stopped out, it's a 1% loss. And so the way that his system kind of breaks down is I'll drag over the statistics here so we can look over them, is with a 70% loss rate, over 10 trades, he'll on average have 7 losers at 1% loss per trade. But his winners make 10% more than, or 10% per trade. So his winners are 10 times bigger than his losers. So because of that, over 10 trades, his losses amount to a 7% loss. His wins amount to a 30% profit with a net profit of 23%, okay, over 10 trades. This is great, right? He has a system that allows him to be wrong 70% of the time and still have incredible profit from his trading. And that's all due to risk management. So let's pretend that his risk management was changed now, and he bumped this up to 5% per trade. And I guarantee you, most of you are risking a lot more than that. Well, now, so what happens when he bumps this up, his statistic up to 5%? Well, these 7 losses now become 35%, right? So over 10 trades, he has a 5% loss now. And I guarantee, again, most of you aren't making 10% per trade on your winners, and most of you are losing more than 5%, or risking more than 5%. But sorry, this would be a net loss. So his net loss is 5%. So what happens over 100 trades? Well, now he's gone from this incredible system that's turned $9,000 into $80 million. And now over 100 trades, he's going to lose 50% of his account. So this is the idea of risk management. Somebody could give you their system, and they could say, I turned $9,000 into $82 million trading this way. And you could say, great. And you could execute it perfectly. You could find every setup. You could trade it perfectly. But if your risk is off, all of a sudden you've turned a system that can turn $9,000 into $82 million into a system that's going to blow up your account. Right? So do you understand the importance of risk management and why it's more important than technicals? It's more important than fundamentals, because you might be right about the direction of a trade, but wrong about the timing. Like you entered here and you thought it was going here. Well, it did, but it blew up your account before you got there. And so the idea is, the way I trade, I might trade this setup sometimes, but if I'm trading down on support, I want to trade these key levels. So let's just say, we've kind of gone over this, but this was a key level here. This is now actually resistance. But so when this key level hits, I trade it. But in case I'm wrong, I want to be out of the trade. So I'm always looking for my invalidation. Well, where's my invalidation? Is it under these wicks? Is it here? Where is it? So if I calculate that, I could say, well, it's 1.5% away. I can put about 75% of my account into this position. Because if I get stopped out, that's about a 1% loss. But the other thing is, you just had a 5% rally, you want to take profits, and you can just move your stop loss to break even. Because what happens when you get stopped out then? You've made money. And you could just, if you're there, you can just re-enter the market. Here, if you like what you see, you can re-enter, take a loss. You've ultimately made money here. You've entered, take profit, enter, take profit, entered, got stopped out, two winners, one loser. So, but the important part is about this, especially with the way I trade, is because I want to trade key levels on the downside on support, there will be times when the market retraces through these levels, right? So you can't blow up your account because you want to trade support levels. So let's just say here, let's just say I'd identified these support levels. Well, if I trade it one way, where I enter and I take profits, enter again, take profits, I'm in the green here, right? And then I try to enter again, I get stopped out. Now I'm waiting for the next level here, and then I enter, take profits, get stopped out, and maybe I've entered again here, which I have, but I'll get to that later. So the idea is here is even though the price has kept moving through my levels, I'm still making money trading them. But if I try to just hold this level, then up to here, and I just get stopped out, lose money. Hold this up to here, stopped out, lose money. If you trade that way, you're going to get blown up, right? Even with 1% risk, if you don't have any take profit strategy, eventually, unless price just never comes below your entries and always goes to the highest part of your target, you're just never going to make money. But imagine if I was putting in 10% or 20% or 30% risk on these positions. And I say to myself, oh, wow, this is a great position. I want to trade it, but do I really want to lose 30% of my account in an over-leveraged position if I'm wrong? No, heck no. Imagine I do it again, 60%, 90%. All of a sudden, I've blown up my entire account because Bitcoin, the asset I'm trading, had a 20% drop. When what should have happened, even if I didn't take any profits or move my stop loss to break even, is I should have lost 3% of my account, or maybe 5% of my account if I was trading with 1.5 risk. Um, and then I can still trade this level of support, and I can make, if I think that it's coming back up, I can make all that money back, right? I can have a low win rate on this trade setup. Although this should be a high win rate. I mean, if you're getting an entry on the bottoms and you're getting a 5% bounce, just take profits and move your stop loss to break even. You can always re-enter the market. You do not need to hold a position till 100K. If there'll be other opportunities, price will come up, it'll come down, go up, it'll come down. So you can, keep entering and exiting the market, at least with some of your position. So this is really important. What happens is when in the chat I hear people saying like they're sweating, they're really nervous. Well, here I am, a great opportunity. I want to trade this. Maybe I'm right at the support. I can open the trade and I can risk 1%. Okay, right here. Do I really need to sweat? If I get dinged out for 1%, that's fine. Right? I can maybe re-enter and trade it again and make money. But if I'm 20x leverage and I'm risking 20% and price starts coming down, I'm getting really nervous. Maybe my stop's here. I just say, oh, I just got to get out of this position. I get out and then, it rallies. You start not thinking clearly. The other thing is, a lot of times when it's coming down, you'll start thinking it will reverse for sure, and you'll start sliding your stop loss down. Because you don't want to get stopped out. Your losses, you've realized that you hadn't accepted that you could lose this trade already. And since you didn't accept it, now you are moving your stop loss to avoid taking any losses, which are just increasing your losses. And maybe you get stopped out, and maybe you see price kind of tick up a little bit, and you freak out and you jump back into the position, and then it goes up and then stops you out again. And all of a sudden you aren't even trading a plan anymore. You're just trying to make back the money you've been losing. And this is what happens when you have too big a position size is you weren't prepared or you didn't truly believe it was possible for price to come down here because you're not accepting that you've lost this trade. And it's fine to lose a trade, okay? It's not fine to blow up 30% of your account in a trade, but you don't avoid that by always being right. You avoid that by using proper position sizing and risk management. So let's just say this, for example. What does it mean to reclaim a level? Okay, so let's just say we come up here and we start reclaiming this level. Does this mean that price has to stay above this level because we reclaimed it and it can't come back down? No, but it's just a trade setup, right? That has a certain probability of being true, and I like to trade higher probabilities. So let's just say this has a 80% chance of going up, okay? So it has an 80% chance of going up to the top of the range, up here. If I enter this, it's a 3 to 1 risk reward ratio, 3.5 to 1. Let's just say I put my stop even under here, right? Because this is where it bounced off the VWAP. It's not on here, but the VWAP and the global point of control. So because price has moved up and taken this level, does that mean I 100x long it or 20x long it? No, because let's just say I have a 20% chance then of coming down to my stop loss, and at 20x long, I'll blow up 60% of my account. So why would I do that, right? Why wouldn't I just risk 1% and trade this out? And if I make a bunch of money, or some money, if I make 15%, if I make 10%, great. And then I just go to the next trade. And it doesn't really matter if I get stopped out because I'm just trading. When this happens again, I'll trade it again. That one might get stopped out. I'll trade it the next time as well. And that one will make 5 times as much money as the other 2 lost. So don't think of your trades as one trade. Think of it as, if I did this every single time I entered a trade, what would happen? And you realize, well, I would eventually blow up my account. It's not a matter of if, it's a matter of when. Is it going to be this time? Is it going to be the next time? So, if you start thinking this way, then you will start trading properly, is the best way to put it. And so that's why I don't use leverage, because, let's just talk about like stop losses. Well, how often is your stop loss going to be less than 1% away? Because a stop loss is arbitrary. I can't just say, well, I'm going to 10x long and put my stop loss 0.1% away, because that way, I'm only risking 1%. Well, you're risking more than 1% because your stop loss is going to get hit 10 times out of 11, okay? Because that's not a real stop loss. A stop loss should be put under structure. And this is, structure isn't price action on the chart. So for example, if I was short here, because I thought we were going to reject, does it make sense for me to, I'll just put this position up here. Does it make sense for me to take a short here, and because I want to have just some crazy leverage position, I say I'm going to enter here, and I want a 50 exit, so I'm going to put my stop loss right here. That way, I only lose 5% if my stop loss gets hit. Well, your stop loss is going to get hit. And then what? You just enter again $1 higher and say, I'm going to do the same thing? Well, you're actually risking, probably 40% on this idea of a rejection. When your stop loss, if you think we're going to reject and say go to 53,000, your stop loss should probably be, I wouldn't even short this, but it should probably be at least here. So you use 1/3 of your account. So why would you ever need leverage if, especially in crypto, you're very rarely going to have a stop loss that can actually be less than 1% away. And the only time you'd leverage a position is if your stop loss is less than 1% away. So yeah, that's the way I think of leverage. It complicates things. People think it's going to just make the money faster, but it's just going to, for one, you're not a profitable trader. And I'm just saying that because statistically, that is going to be true. You might have made some money, but over the course of the next year, you will find that you'll have lost money. And so leverage will just exacerbate those losses. But you don't just keep adding leverage as you become a better trader. Even the best traders in the world use this system. And so if the best trader in the world is going to look at his Bitcoin trades and use a system where he's only using 1 to 1.5 risk, is he ever going to 10x leverage a position with his whole account? No, right? Because he's very rarely going to have a setup that his stop loss is 0.1% away. That's gambling. If you just want to take a crazy position and put your stop loss $1 under your price and just cross your fingers, go for it. But that's just gambling. It's not proper trading. Yeah. So the way you should have a system, and when you have a trade set up, don't just think about where you want to enter. Think about where you want to take profits, and think about where you want to get out. Let's just say I was trading this ascending trend line idea. Okay, so price is coming up. I'm entering here. Where's my stop loss? Is my stop loss going to be just arbitrarily? Why do I always have trouble finding this tab here? Is it going to just be arbitrarily low? I entered on the trend line and I just put it right under the trend line? No, that doesn't really make sense because price deviates a little bit. Do I just put it under this low? That could be a setup, 1.3% away, but I would rather just have a better chance of the position surviving and put it maybe under this low, right? Or even under this low, although your risk reward gets kind of weird. Yeah, so you'd put it under something like this, and you'd position size accordingly, which would be about half your account, maybe 40% of your account. The other thing I want to talk about is risk reward ratio. So, this is good. You have almost a 6-to-1. But what if I was trading a setup that looks something like this, right? Whatever it is. I just said I'm going to risk, just for the sake of the argument, my take profits up here. I'm going to risk $1 to make $1. Well, if you do that 100 times, what's the point? At best, you'll break even, but then you have fees, so you're going to be behind. So you want a risk reward ratio that allows you to be wrong a certain amount of times, more times than you're right, and still make money. So you want to be looking for something at least 3-to-1, maybe 4-to-1 as your risk reward ratio. Because over the long haul, you're not going to make money otherwise. Yeah, so it's in risk management, it's not just a matter of position sizing and where your stop loss is. Your take profits and your targets are a part of that because, your risk, if we define kind of risk, reward, your risk has to be put in the context of your reward. So yeah, you might be risking 1% of your account because your stop loss is 5% away, or yeah, I'll just put it at 5% for the example. And you did 1/5 of your account, so you're risking 1%. But you're risking 1% for what? Are you risking 1% to make this? Well, why would you ever do that? This setup is going to destroy your account. You need to have a risk reward ratio that makes sense. So to kind of recap, when you're setting up a trade, there's three components, okay? There's your entry, there's your invalidation or stop loss, invalidation/stop, and then there's your target. So before you enter, you should have all of that, right? So like for me, let's just say I'm going to make an example. I entered a trade here. Maybe this SR flip. SR is support resistance. So this was support, now it's resistance. This SR flips a take profit. This is a take profit. This is a take profit. This is just an example. This is all determined when I enter. My stop loss is determined when I enter. Maybe it's down here. And so I'm calculating how big is my position, where's my stop loss, where's my targets, and then I'm just presetting my take profit bids here. Take profit, take profit, take profit, and then maybe I do a trailing stop loss or manually just keep moving my stop loss up under the levels. I like to take profit and then move my stop loss up where I think it will hold, because some people just hold their position and just move their whole stop loss up, but that's not a great way to trade because you'll get stopped out of great positions all the time. So you could have had an entry here, you moved your stop loss, and now you get stopped out here, and then we just go on this huge rally with no retrace, and you miss all of this. When you could have just taken some profits and kept your stop loss a little lower so your position can survive, take some more profit, keep your stop loss down here, instead of moving your stop loss right under the new low every time, because you're trying to let your positions run. So yeah, I think this is fine for an entry video into these concepts. I'm going to do some more stuff on risk management and position sizing because it's just so important. I mean, there's nothing else that matters if you don't understand these concepts. So hopefully this was helpful to you guys. Hopefully no one got too dinged up on this job here. You kind of understand some of these concepts a little better. All right, happy trading.